In 1994, India, a fast-growing country with massive runway, opened up its banking industry and gave banking licenses to private banks. A Citibank top global banker, Aditya Puri, who was based in Malaysia then, was invited by the chairman of the leading housing finance company in India, HDFC Ltd, to start a new world-class Indian bank called HDFC Bank. After building the HDFC Bank institution for about 3 decades, HDFC Bank has now grown to become one of the top 20 banks globally. And its Indian shares have compounded by 27% annually since its listing, becoming an almost 300-bagger in about 24 years. And the current CEO thinks that there are massive opportunities ahead and very long runway ahead for HDFC Bank to continue compounding wealth for another 50 to 100 years. If that happens, that's a real compounder business with real longevity that we are looking at. And the good thing about this company is it has a US-listed ADR under the ticker HDB, listed in the New York Stock Exchange. So we global investors would be able to buy into this company's stock too. And that ADR has compounded to about 47-bagger in 21 years' time since listing, which is a compounded annual growth rate of about 20% in the last 2 decades, which is why today we will be talking about HDFC Bank, which could be a good way for investors to expose themselves to the growing Indian economy with long runway through a wonderful business franchise. We have done a deep dive research into HDFC Bank and set out our analysis in a 190-page report for those who want all the details. And today, we will focus on talking about the current merger of HDFC Bank with its parent company, HDFC Ltd, which we think will be game-changing and place HDFC Bank in a very strong position to compound its growth and shareholder value for many decades to come. And before we talk about the merger, we will give a quick introduction into HDFC Bank's business to provide some context for those of you who are unfamiliar with the bank. Before we start, this is Fan Liang from MoneyWise Smart.
It takes a long time to research and prepare the video, so your support will go a long way in motivating us to produce more investments videos like this. I would really appreciate if you can help to smash that like and subscribe buttons so that more people will get to know about this video.
And here is our disclaimer that this is not investment advice and is for educational purposes only. Let's start with HDFC Bank's founding. In the early 1990s, the banking situation in India was that foreign banks had good products and service, but not the scale or distribution to expand well, while the public banks had the scale and distribution, but not good product or service. And Aditya Puri thought that by combining these two strengths together, he could build a world-class bank together with a strong team of people, and he managed to convince about a dozen people to join him in building this top institution, with all of them risking their good positions in top banks to join this startup bank, with minimal pay then, but with equity. Due to a lack of wide network of bank branches, HDFC Bank focused on corporate lending, providing various credit and transactional services to corporates with a focus on service quality, and gradually expanded its services to an ecosystem solution, including lending to the corporate customers, stakeholders like vendors and supply chain parties. Over time, HDFC Bank built up a wide national network of bank outlets, including more than 6,000 branches in more than 3,000 cities and towns. This wide network is somewhat larger than the second largest competing private bank and much larger than the third largest private bank, which allowed it to expand its retail banking fast, collecting low-cost deposits from retail customers and also selling various loans like personal loans, car loans, credit cards, mortgages, business loans, etc. to the retail customers. HDFC Bank also has treasury operations to manage the treasury needs of its customers, including foreign exchange and derivative transactions, which it earns a fee income from the customer transactions. Let's now talk about the merger between HDFC Bank and HDFC Ltd, which was announced in early April 2022 and is now expected to be completed in around mid-2023 instead of the earlier expected end 2023. So HDFC Ltd is the parent company of HDFC Bank, which was established earlier in 1977 and is the largest housing finance business with a very strong branding in India. Meanwhile, HDFC Bank has not been participating actively in the mortgage business as it would otherwise be competing with its parent company. So it has just been sourcing mortgage loans for HDFC Ltd and repurchasing some of them back to put on its books. And currently it has a small 11% exposure to mortgage loans on its books. With the merger, HDFC Bank would be able to expand the mortgage business much to benefit from the large mortgage market and strong growth in India. Currently, HDFC Ltd owns in total about 21% of HDFC Bank's shares. The transaction terms are such that after the merger, those 21% shares of HDFC Bank will be cancelled, and the existing shareholders of HDFC Ltd would get 42 shares of HDFC Bank for every 25 shares of HDFC Ltd shares that they owned. The merger would bring a lot of benefits to both the businesses, and one key benefit is the cross-selling opportunities available for each other. Now, within HDFC Bank's about 70 million customer base, only 2% of its customers have a mortgage product with HDFC Ltd, and about, say, 5 to 8% of its customers have mortgage products from other providers. And because mortgage loan size is larger, that 5 to 8% is equal to the size of HDFC Bank's retail book now. On HDFC Ltd's customer base, 70% of its customers are not banking with HDFC Bank now. So there's another huge opportunity to cross-sell them HDFC Bank's services, like credit cards, personal loans, insurance products, and also consumer durable loans, which can be packaged together with the home loans, since people purchasing houses are likely to purchase consumer durables like furniture and electronics too. So there's a lot of opportunities there to grow without incurring much cost to acquire new customers. Another benefit of the merger is that currently, although HDFC Bank has a wide distribution network that reaches into the deep geographies of India, it can only sell the mortgage loans as an agent instead of as an in-house product due to the competition with HDFC Ltd, which would otherwise make the selling and servicing easier, faster, and seamless. This would change after the merger, and HDFC Bank would be able to fully tap on the power of its wide distribution network to expand its mortgage loan business significantly, and its bank branches could be used to service the loans, including the signing of the loan documents. And now is a good time to be in the mortgage market, as there are various favorable tailwinds now supporting the mortgage industry, which would help the industry to be one of the major drivers of India's economy in the next decades. And this merger would allow HDFC Bank to not miss out on this major opportunity. And currently, HDFC Bank has the ability to gather the capital required to grow the mortgage business significantly, where it has expanded its number of branches significantly recently, and it intends to continue so in the next few years. And right now, most of its branches are young and less than 10 to 15 years old, and as they mature, they will be able to source deposits more effectively, providing the capital required to grow the mortgage business at low cost. In addition, as mortgage loans have longer tenure of about 20 years, by expanding its mortgage loan book, HDFC Bank would be able to increase its overall loan book duration, which gives it more space to breathe without constantly having to replace the old loans with new loans while it grows fast. Furthermore, mortgage loans are quite emotional products, where the customers do not really want to default on their houses unless really needed. So these mortgage customers are likely to maintain a longer and stickier relationship with HDFC Bank, and trusting the bank, making it easier for the bank to sell them more services over their long repayment life cycle. And having more data on those customers from those mortgage loans also help HDFC Bank to assess their risk better, reducing the credit cost to the bank. HDFC Bank CEO Sachida thinks that after the merger, which allows the bank to enter into the mortgage business, the bank would have really long runway of 50 to 100 years. And for us investors, that means that it can be a great compounding machine with significant longevity, which is not easy to find in the world. One concern about the merger is that after the merger, HDFC Limited's business, which used to be not regulated as a bank, will now be regulated as a bank, and the combined entity will have to fulfill the regulatory requirements, like maintaining enough liquid assets to fulfill the cash reserve ratio and statutory liquidity ratio, and lending enough to priority sectors. On this, the CEO Sachida has explained that they will be able to fulfill all these requirements without much complications, and we have discussed this in more detail in our detailed research. Now, coming back to the valuation of HDFC Bank, we think that after the merger, HDFC Bank's valuation will be quite much higher, and we'll talk about several impacts from the merger on the bank's valuation. First, right after the merger, because of the transaction terms, HDFC Bank would get a boost to its book value per share by 7.7%. So its book value per share would jump from 414 Indian rupee to 446 Indian rupee. Assuming the combined book value is worth the same PB multiple, then that leads to an uplift in valuation of 7.7% just because of the merger itself. Second, as HDFC Limited is not a bank and cannot collect deposits from the public, its cost of funding has been higher than the banks, although it still manages to achieve high profitability and become a strong leader in the industry, which is a strong fit. Now with the merger, HDFC Limited will be able to leverage on HDFC Bank's lower cost of funds, where HDFC Bank benefits from its low-cost current and savings accounts, or in short, CASA accounts. And as we can see here, historically, HDFC Bank's cost of funds is lower than HDFC Limited's by about 2.2 to 2.8 percentage points. Another data shows that sometimes HDFC Bank's cost of funds could be even lower than HDFC Limited's by 3.2 percentage points. So let's see what happens if after the merger, HDFC Limited's business manages to reduce the cost of funds by about 2 to 3 percentage points. Let's start with a 2 percentage point reduction in cost of funds. In financial year 2022, HDFC Limited's net profit was 137 billion Indian rupee. If its cost of funds dropped by 2 percentage points, and assuming a 25% tax rate, then its net profit would roughly increase by about 75 billion Indian rupee to 212 billion Indian rupee. And the combined entity's net profit will become around 582 billion Indian rupee, which is a 15% increase from the case if the cost of funds remains the same. And so if P multiple remains the same, then the value of the combined entity would also increase by a similar 15% if the cost of funds is brought down by 2 percentage points. Similarly, if the cost of funds is reduced more by say 3 percentage points, then the increase in net profit of the combined entity and the value will be about 22%, which is why we said after the merger, HDFC Bank's valuation will be quite much higher. In addition to these two drivers, there are also other financial benefits coming out from the merger, which we have discussed earlier, which would help HDFC Bank to grow well and compound well into the future. For example, the cross-selling benefits to each of HDFC Limited's and HDFC Bank's customers, the stronger customer relationships with mortgage customers, allowing the bank to sell more services to them profitably over the long mortgage repayment cycle, the lower credit costs due to more visibility and data over customers, and cost efficiencies from synergies from the merger, etc.
For the remaining points of this video, you can check them out at our multi-bagger research series. At MoneyWise Smart, we do deep dive research into wonderful companies to own for the long term. We have provided some of this research for free in our free research series, so definitely check them out at the link provided if you want to invest in good companies. I promise you will really benefit a lot from this research. If you have enjoyed this video, do hit the like button now, and don't forget to subscribe and hit the notification bell so that you'll be notified of our future videos. Do also join our Facebook group where we discuss interesting investment concepts and businesses. Thank you for watching, and see you in our next video.